When you first start investing, one question shows up almost immediately. Should you invest consistently or wait for the market to drop? In other words, should you use dollar cost averaging or try to buy the dip? One of these strategies quietly builds wealth over time. The other can feel smart in the moment, but often leads to hesitation and missed opportunities. In this video, we'll break both strategies down in a simple and practical way. We'll walk through real scenarios, look at long-term data, and most importantly, understand why so many investors struggle with this decision. Welcome to Money Mind Lab, where we make investing simple and practical. Let's start with the first strategy, dollar cost averaging, or DCA. DCA means investing a fixed amount of money at regular intervals, no matter what the market is doing. For example, you might invest $500 every month into an index fund. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, this averages out your cost. But here's something important many beginners don't realize. DCA is not just for beginners. In fact, even experienced investors use it as a core strategy because it removes emotion from the process and keeps them consistent when markets become unpredictable. Most beginners use DCA with a broad market index, like the S&P 500.
Why? Because it gives instant diversification across hundreds of companies, reduces the risk of relying on a single stock, and historically trends upward over the long term. This is why even legendary investor Warren Buffett has consistently emphasized the power of long-term, simple investing strategies, like index funds. Now, can you use DCA for individual stocks? Yes, but it carries more risk. If you pick a strong company, DCA can work well. But if you choose a weak or declining business, DCA simply means you keep buying more of something that continues to lose value. That's why many investors use a balanced approach, a strong core in index funds and a smaller portion in individual stocks for growth opportunities. Now let's talk about buying the dip. This strategy is based on timing. You hold your cash and wait for prices to fall before investing. The idea sounds simple. Buy assets when they're cheaper. But here's the problem. What exactly is a dip? Is it 5%, 10%, 20%? And what happens if the market drops and keeps dropping? Or worse, what if it never drops enough and you miss the entire rally? Trying to buy the dip perfectly is like trying to catch a falling knife. You don't know when it stops until it already has. Buying the dip assumes you can recognize the right moment and act quickly. In reality, even professionals struggle to do this consistently. Markets tend to rise over time, which means waiting too long often leads to missed opportunities.
Let's look at a simple example. Meet Daniel and Marcus. Both have $6,000 to invest over 1 year. Daniel uses DCA, investing $500 every month without fail. Marcus waits. He plans to invest everything only if the market drops at least 10%. Early in the year, the market falls by 8%. Marcus waits for a bigger drop. But instead, the market recovers and starts climbing. Month after month, he stays on the sidelines. Meanwhile, Daniel keeps investing consistently, buying more when prices are lower and less when prices rise. By the end of the year, Daniel is fully invested. Marcus is still holding cash, unsure of what to do next. This is the hidden risk of buying the dip. It's not just about being right, it's about being right at the right time. Now let's zoom out and look at long-term results. A well-known study followed different types of investors over a 20-year period, all investing in the S&P 500. Each investor used a different strategy. One had perfect timing, buying at the lowest point every year. Another invested immediately each year without hesitation. Another used monthly DCA. Another had the worst timing, always investing at the peak. And one stayed in cash, waiting for the perfect moment.
The results were surprising. The perfect timer came out on top, but only slightly ahead of the investor who simply invested consistently. The DCA investor performed very close behind. Even the worst-timed investors still built significant wealth just by staying invested. But the one who kept waiting, they fell far behind. Here's the key takeaway. Time in the market beats timing the market. Investing isn't just about finding the best strategy. It's about whether you can stick to it when the market gets uncomfortable. Now, there's one more layer to this. Historically, investing a lump sum early often produces the highest returns because your money has more time to grow. But not everyone is comfortable investing a large amount all at once. That's where DCA shines. It may not always give the absolute best return, but it gives you something just as important: consistency and peace of mind. And in investing, consistency is what builds wealth. Some experienced investors combine both strategies. They invest regularly using DCA, but also keep a small amount of cash ready for major market drops. The difference is they don't rely on dips. They stay invested first. Because investing isn't just about numbers, it's about psychology. It's easy to say you'll buy when the market crashes, but when it actually happens, fear takes over. People hesitate, they panic. Sometimes they even sell instead of buying. That's why simple strategies often win. If you remember one thing from this video, let it be this. The biggest edge in investing isn't timing, it's behavior over time. Before you go, just a quick reminder. This content is for educational purposes only. If you found this helpful, hit the like button and subscribe to Money Mind Lab for more simple, no-nonsense investing content. And let me know in the comments, are you team DCA or do you prefer buying the dip? Thanks for watching, and I'll see you in the next video.